Good morning. It is Monday, December 2nd, after a long, beautiful holiday weekend. This is the Zero DTE morning market analysis, our situational report. I want to start it off by saying that December is one of the more positive months on average over the long term, over the past 50 years. I'd say that 70 to 75% of the time it ends up positive for the month, and actually one of the largest on average percentage gains for the month. I think it's somewhere between 1.2 and 1.3% gain on average. And if you compare that to other months, it is a stark difference. About 68-70% of the time between the period of Christmas and New Year's, we often have what is called the Santa Claus rally as well. So most things that happen in December are relatively positive, so we're expecting much lower volatility. Volatility on the VIX is already very low. There's a possibility that there could be some disruptors to the market and increase that volatility. I mean, there's a clear possibility in many respects, both with our economy as well as internationally. I mean, we have the conflict over in Ukraine with Russia, although that seems to be coming to a head somehow. It appears that President-elect Trump is negotiating some sort of settlement between them that they might be into. Here in the States, things are kind of copacetic. I think Wall Street is looking forward to the incoming administration. At least some people are. And there is the lingering issue of rate hikes or cuts by the FOMC. And that will come on, I believe, December 18th. And they are looking for a 25 basis point cut in the rate. So that'll be interesting. The cut itself, I think, has a 65% probability of occurring. And if it does, what will be more interesting to see is the narrative that Jerome Powell gives after the rate cut. What else? There's this week, there's not much going on. I mean, there are some economic reports and everything, but with everything kind of upbeat, I think the next thing we're looking for is to see what numbers come in from the retail sector after Black Friday events are over, although it doesn't seem like they're ever over. Black Friday events start about a month before Black Friday, and then they keep on going through Cyber Monday for another week or so. That'll be interesting to see whether or not people are actually emptying their pockets into the retailer. There are nominations to the new administration that are coming in that are causing quite a stir. They may also cause some kind of upset, but I don't think that they're going to be much, to tell you the truth. Today or last night, President Biden pardoned his son, Hunter, of everything, basically, going back on his promise not to pardon him. So I think that might cause some disconsternation amongst both Democrats and Republicans, and I don't know how that translates to the market. It might. So all in all, I don't expect a lot of change going forward. I think that it's going to be steady as you go. And of course, when volatility is so low and it is creeping down in the basement there in zombie land, we do always come up with some sort of surprise that will spike it up. Not always, but usually you can expect when it gets too low, it's got to rebound. So why don't we start by going and looking at where volatility is right now, and we're trying to assess three things. Where volatility is, so we can figure out our exposure to the volatility that's out there. In other words, how wide we go, how much we're willing to risk with our out-of-the-money butterflies and our asymmetric strategy. We're also interested in the short-term volatility and see whether or not there is an opportunity for a volatility crush event in the morning. Although in this kind of environment, I'm going to say no. And then if there is an opportunity, we want to see where that setup might come from based on the market structure. All right, so let's get started. Well, that's not exactly what I'd like to see, but we need to see something else. Well, that's the economic reports. We can start with that. There are some reports out there, but not a whole lot of interesting stuff. At least we can take a look at what's going forward this week. And we have final and ISM manufacturing PMI and prices, and we do have an FOMC member speaking today. But all of these reports happen after the market opens, which leads me to believe that a pre-market trade is probably not going to be very interesting. And Tuesday we have JOLTS. We have this is the week of economic or employment reports. So we have JOLTS and we have ADP on Wednesday, and then of course on Thursday unemployment claims, and then on Friday the unemployment or the employment situation report. So this week is all about employment, and that might have some ability to rise volatility into the end of the week, but probably not. All right. So let's see. Let's go on from there. Let's get to our charts. So we can see clearly volatility has dropped dramatically since, it looks like mid-November. It's been straight down. Currently at 13.96, and if we move over here to our classic out of the money width guide, we can see that we're looking at very narrow widths between 10 and 20. We're also in the spectrum of putting on multi-day DTEs to try to take advantage of this decreased volatility and the lack of price movement, and also the increase in premium decay. So by going an extra day out, we can capture more premium. But we do that very carefully, and we're not going to try to increase our risk to try to do this, right? So that's about it on that VIX account. Let's take a look at where we are in terms of direction. At least from the SPX, we can see that the market is up. We've had quite a move here since November 15th. If we look at it from the perspective of the futures, we can see that even though we have low volatility, we've had a lot of big ranging days. And so that's important to note. And one of the reasons why I might be more in tune to a multi-day DTE. So keep that in mind. In other words, today we might put on a trade for today, tomorrow, and Wednesday. And I think that because of the increase in the rate of decay, a lot of these flies will already have a lot of value in it. So if we do get a move, even if it's a day or two out, we should be able to see significant profit in one of those without having to go to the very last day of expiration. So that's something to look forward to, I guess. And let's go to... I'm working backwards here, so just have a little patience. I'm looking in a mirror, is what I'm trying to say. Let's go to Thinkorswim and see what the situation is on our big ass fly and volatility for the morning. Well, we can see clearly that decay has increased rapidly, and the way we can tell that is by the huge amount of debit that we have this morning compared to the potential profit. So the real-time profit curve has really increased its, a lot of times we see this curve way down here and there's a lot of potential profit for this trade, but right now the debit of this fly is at 32. And if we were to look at that on our VIX guide, we would see that that means go even narrower, take even less risk. Because the gamma risk is super high. The gamma you can look at from a perspective of the slope of the real-time profit curve. The steeper the slope, then that means the higher the sensitivity to price movement. So we have a lot more risk, a lot less potential profit, and higher gamma. I mean, that's simply not a situation that anybody would want to delve into. So there you go for that. Now, sometimes we can see a little opportunity in the NQ, the NASDAQ, because it has more. Let's see if I can get to it. It on average has more volatility than the ES. And I would say that does have a possibility for a big ass fly this morning. If you have futures in your trading platform, you might want to look at a 150 wide at the money NQ trade. And I think that that might produce some good results this morning. We should have 2 volatility crush events, one after the economic reports come out early in the morning, after the market opens, and then possibly another one later. I would look at this particular trade now. Consider that the NQ is a much larger index, although the NQ E-mini futures is only 20 cents on the dollar. So the big point value or the multiplier is only 20 cents. So for every dollar, it's really only 1/5 or 20, it's a lot smaller. So you can put on 150 wide without breaking the bank. You can see that this 150 wide fly has a max risk of $1,265 and a max profit of about $1,750. So it's better than a one-to-one trade. The gamma risk on this is going to be relatively small, but you would look at your stop being around $10 for that. So $10 would be about $200. All right. So we have that to look forward to. And, well, there you go. So I think that the NQ looks like a possible trade this morning. The out-of-the-money butterfly, if we're going to put one on, I think maybe doing a 0 and a 1 and a 2 DTE might be our best bets, keeping our width small and our risk small, and waiting and hoping for one of those, I guess you could call it an existential volatility event, but we just don't know when they're going to happen. And when they do, we're happy. When they're not, we just lay back and take it all in. So that's about it. I want to thank you all very much, and happy trading. Coach Ernie, out.